Let's say you've got around $1 million saved, whether it's in super, a trust, or a personal investment, and you want to make smart decisions with it. How should you actually invest that capital? In this video, we'll break down how we think about portfolio design, asset allocation, and structure. And we'll show you how we help clients invest for both income and long-term growth and confidence. Before we dive in, I'm Eden Smith and I'm joined by my father, Cameron. Welcome to Wealth with Purpose, where we share strategies to help you grow, protect, and enjoy your wealth. Together, our private wealth and investment firm, Benson's Wealth, has helped countless Australian families and individuals build lasting financial security, and we've been doing it for over 35 years. Everything we share with you today is general in nature and doesn't take into account your personal circumstances. Let's get started. Cam, how are you, mate?
Good. How you doing?
Pretty well, thank you. Good to see you. Mate, we got this question last week. Got $1 million. What do we do with it?
Really good question.
Great question. Something we see all the time, be it an asset sale, an inheritance, exit of a business, you name it. Sitting on $1 million, how do we invest it and what should we do? Three big considerations that we think through. The first being starting with structure before building a portfolio. So getting the money into the right bucket, which we'll talk about. The second is actually designing and building that portfolio, of which we feel diversification is fundamental. And then the third thing is confidence in actual planning, not just performance. So we'll touch on those today and we'll get granular where we need to. So kicking off with number one, starting with structure. Talk to me about investment structures and the effect that has on capital.
Absolutely. The ones we see most of today are basically superannuation and also money's held personally in people's names. So structuring's so important with retirement planning. If I can just talk quickly about money held personally in someone's name, it's all about the tax that you're actually paying. Basically, money's held in your personal name, you're going to pay tax at your personal tax rate, which can be anywhere as high as 47 cents. Right at the other extreme is the structure of money being held in a superannuation pension where you pay 0% tax, and then we've got superannuation where tax is paid at 15% and a little bit less for capital gains tax. But the structuring is so important.
Great. We also have trusts and companies in Australia. It's quite a simple tax system. Companies, generally speaking, are going to pay that 30 cents in every dollar, 30% tax, not entitled to a capital gains discount, which is very important. And trusts, you can distribute income to who you see fit, and you'll pay tax anywhere from 0 to 47 cents in every dollar as well. But you're right, fundamentally, we often see in 8 out of 10 cases, superannuation and personally held investments. So what I'm hearing there is funnel as much money as we possibly can into super, ultimately to get that into pension, where income is completely tax-free. So don't just invest, but clarify where the money's going before doing so. Can you just touch on very quickly the access rules of superannuation, something to be mindful of when it comes to liquidity or illiquidity?
Sure. Again, with superannuation, obviously that's a structure where the government want you to get as much in there. They have obviously give you concessions to get money in there, but there are rules around when you can actually access it. But basically, most people access their superannuation when retired, where you must have met, your preservation age, which is at least 60 now, and must be retired. There are some other little rules around if and when you can access after 60, but generally speaking, after 60, at some point that you retire, that's when you can access the money. Pre 60, there are lots of considerations as to whether to put money into superannuation from an accessibility point of view, but you can't actually access your money in most cases before age 60.
Okay. And it also depends on if you're working and what your marginal tax rate is, or if you're earning income from another source, or even just having a year where you sell, say, an asset and you have a big capital gain. If you have money personally held where you weren't paying income tax on it, you may be facing income tax in that financial year just by circumstances. So, um, obviously, always get professional advice, but really important is getting the money into the right buckets.
Absolutely.
Cool. Second thing, and arguably the most important, is how we actually build and construct a portfolio, or how we would do that if we had $1 million. Um, Paramount to everything is diversification. Um, and then we want to balance income, growth, and really risk mitigation, or protecting that capital. So,
Sure.
can you talk through how you think about that?
Yeah. Everyone's portfolio is really different, and it should be built with your goals and objectives in mind. But generally speaking, we have a wide range of investments that we look at, and typically that's a mix of equities, both locally and globally, and things like private credit, fixed interest, property, and the like.
Okay. Um, and I guess from the outset, if we're building a portfolio, what we're considering, you know, goals and objectives in mind. Generally speaking, we want an income layer. So, be it dividends, frank dividends, credit, bonds, infrastructure. We want some stable and regular income coming into the portfolio.
Yeah,
Um,
and to
you want,
supplement that, we want a growth layer as well, which is your managed funds, ETFs, and quality stocks.
of course, and that's, I guess, long-term thinking, protection against inflation, and just having your money earn for you effectively, or work for you. Um,
And above all, good quality managers that, um, they're not it's not gonna blow up your capital.
okay, cool. So, full circle. Goals and objectives are paramount. Diversification, super important. First and foremost, we want to make sure we're not blowing up capital. We want an income layer producing steady income for the portfolio. You want a growth layer for long-term growth and to protect against inflation. And we want to make sure that we're employing really good managers so that your capital is protected, and we are high up there in the capital stack. Um, the third big consideration, I guess, is planning, and not just focusing on performance. So, volatility is inevitable. Having buffers in place and having a strategy that effectively avoids panic is super important. Can you share your thoughts on that? Talk to that.
Yeah, we just look at this century, we've had a few major, uh, things that have happened in around the world, September 11, GFC, COVID. Volatility is a given in the market, so, they do go up and down, but over the long term, they go up more often than they go down, and history tells us that. So, volatility is important. So as you indicated, having buffers and strategies help avoid that panic, and it's really the education piece comes from planning these things out, and knowing that you're going to be safe and secure, and everything's going to work to the plan. So,
And what is a bucket strategy? A strategy
okay.
that you would employ?
Yeah, typically, with a bucket strategy, we tend to hold, a couple of years income payments in very defensive or income producing, even cash. We often have a couple of years worth of income payments in cash. Then we have a second bucket, basically with some lower growth options to get us a better return than cash. Which we can then top up bucket one with from bucket two, and then typically bucket three we have our more growth orientated investments, which are going to have a bit more volatility, but are going to generate the growth that the portfolio needs over the long term.
Okay. And the reason for doing so is, I guess, you're holding, a reasonable reserve in the cash bucket or in term deposits and fixed interest cash equivalents.
Yeah,
Um,
it's really so we don't have to sell those longer term investments in the volatile market. So we're drawing down on the the um, the income producing assets, basically.
that's great. Thanks for sharing. I think we've answered that. Good chat.
Absolutely.
So, what I'm gathering is smart investors don't necessarily chase their tail for returns. They follow a strategic plan. They allocate capital in their portfolio and they stick to it. And over the long term, that yields good results. And as equally important as a strong return is, it's really protecting that return during a downside period, especially if you're drawing on the income in retirement.
Yeah, a disciplined approach is very important.
Great. Thanks, Cam.
No worries.
Guys, thanks for watching today's episode. If you're not sure where to start, we've developed a retirement readiness quiz. It's free. It'll help you assess where you're at and what needs attention. It's in the link below. Good luck. Thanks, guys.